And to hike or not to hike? That's the question the Federal Reserve will ponder as it makes its next decision. Annual inflation was down to 6% in February and the labor market remains strong. These economic indicators would typically point to another rate increase Wednesday.
Taken in isolation, I mean, the economy looks very, very good right now. And yes, the Fed would probably be raising rates by 25 basis points without what's going on right now. That said, what's going on right now is very unsettling.
I think what matters is, can they stabilize the banking system so they can free up their ability to tackle inflation?
But the Silicon Valley Bank and Signature Bank collapses raised questions about how much banks can handle. Meanwhile, the recent rate hikes put pressure on consumers from both sides. They're still facing high inflation while paying more in credit card interest on mortgages and auto loans. Joining me is Chance Finucane, Chief Investment Officer at Oxbow Advisors. Now, we have the Fed meeting tomorrow, Chance. Let's just for a moment put aside what the Fed will actually do. I just want your thoughts on how you feel about all this. What do you think is the right move for the Fed? Pause or continue to hike?
It's a tough call. I think given that inflation is still at 6% and probably is only going to come down to about 4% before it stalls out at around 4% for a while, they probably still have to hike a little bit more, but you're seeing things break now in the financial markets. And what's interesting to us is the thing that caused the issues with Silicon Valley Bank and Signature Bank, those were treasuries and mortgage-backed securities. We didn't even get into the commercial real estate loans that have been given out by small and mid-sized banks. And we think that could be an area that you see weakness in the months or quarters to come. So I think right now it's just a very difficult time for the Fed. And this was sort of what we were anticipating, that they're going to be in a difficult spot with inflation being higher than they want. They can't start to ease or try to assist the situation like they would have in the past 10 years.
Right. They're between a rock and a hard place. But the market seems like to be expecting 25 basis points tomorrow. What do you think? How are you going to interpret that in terms of the economy and the banking sector? What message would the Fed be sending with that?
It seems like that's expected, the 25 basis points, and then it wouldn't surprise us if what they discuss along with that decision is going to be sort of like a pause and start to really assess things. And probably they're just hoping that inflation starts to come down faster so that it makes their decision making in the future a little bit easier. But what we pay attention to is a lot of the lending growth in the U.S. economy comes from small and mid-sized banks. The majority of commercial and industrial loans, commercial real estate loans, consumer lending, and residential real estate, those loans are coming from these sorts of banks that are having trouble keeping their deposits. It's not the mega banks like JP Morgan's and Wells Fargo's of the world. So if this is the situation we're in, you're going to see a slowdown in lending, which is going to further slow economic growth, which is going to make it a difficult environment for companies to generate any profit growth and keep up their margins.
And if we do get a 25 basis point hike tomorrow, does it change your investment strategy, or has your investment strategy changed over these past few weeks?
Our strategy really has not changed. What we've done in recent weeks as the volatility has spiked here is really paying close attention to everything we own in our clients' portfolios. And if we see anything that we think has an outsized risk and not a whole lot of reward left to it, we're getting out of those positions on days that those securities trade higher, so that we're really making sure we're mitigating the risk in the portfolio. But there really hasn't been much for us to change, since this is the sort of outcome we've been anticipating for quarters through pretty much all of 2022. And we would expect that sort of high risk scenario to continue in the months ahead.
Right, and you make a good point. I mean, is that the name of the game right now, to eliminate risk, in your opinion?
Yeah, we believe it is. So you haven't seen asset prices get down to levels where it's in your best interest to start really getting a bit more aggressive and thinking more about the upside rather than the downside. You've seen some real big problems in a few isolated areas of the market right now, but if you look across all the different sectors, things are still pretty fairly valued, if not a bit overvalued. So with the decelerating economy and some more issues happening in the financials part of the market, it's really not best place to be thinking about upside or opportunities. You'd much rather be focusing on staying defensive and waiting for a better opportunity down the road.
And maybe you can shed some light on banks in light of recent events. Now, if I'm an investor and I have some investments in banks, what's your advice for me?
It depends on which banks you're invested in. So if you're invested in some of these small and mid-sized regional banks, on a day like today where the market's trading up a lot and there seems to be a relief rally, that would actually be where we'd be probably trying to sell out of some of those positions, just because the problem right now is even for the banks that are well capitalized and not going to be at risk of going bankrupt, they're going to have to raise the rate on customer deposits that they pay to those customers. And that's going to cut into their net interest margins and is going to hurt their earnings per share. So these companies that look like they were really cheap, trading at 8 or 10 times earnings per share, that's not going to be the earnings they report over the next 12 months. It's going to be a lower earnings number, and therefore that valuation multiple is higher, and you're going to see the share price come down. And that's what you've been seeing over the last couple of weeks. So right now, you're not at a time where it really pays to take risk in investing in banks. So for common stocks, we don't own any bank common stocks at this point in time, just because you're not at the point of the cycle where you're really being incentivized to do that.
Right. You're absolutely right. There's a lot of volatility here. At Oxbow Advisors, where do you see safe spots in the market?
So what we've noticed, we've put some allocation into gold royalty businesses or gold miners. That's been an area that offers some diversification, and on certain days when everything else in the market is going down, they can trade higher because it's a relative safe space to be. We also think there's still some opportunities in the healthcare sector. So we own a few healthcare insurers that are trading at reasonable multiples. And then if you're looking for yield, there are still some areas that don't necessarily offer a lot of growth, but have consistent cash flow and pay a high dividend. So for our high income strategy, we recently purchased positions in names like Verizon and Kinder Morgan that pay a 7% dividend yield. And we think that dividend is sustainable, and you're buying at a valuation that's below its historic average. So we think that's a relative safe space to be as the rest of the market is going through a choppier environment.
How do you feel about energy? Is that a risky asset in light of a possible recession?
It is. The only energy positions we own are in the pipeline businesses that can generate cash flow regardless of what happens to the oil price or the natural gas price. If you're owning an energy business that's more of the front part of the whole cycle, so like an exploration or production business like Devon Energy, they're seeing much higher cost inflation just as the oil price is coming down, which is really going to take a hit to their profits. So typically when you're this sort of late cycle heading into a recession type environment, it's the worst time to be invested in energy. There still is a long-term opportunity for energy stocks, but right now is not the time to be looking for that. You're going to need to see a little bit more of a downturn in something like the XLE sector ETF is just a broad example of what's happening to energy stocks. You need to see that move lower before you really think you've got a great entry point again.
All right, thank you very much, Chan. It's a pleasure having you on the show today.
Thanks, Don.